topic some people may not want to talk about. I mean, really, you're planning in the event of your death.
Definitely.
But we did have a lawyer here a few weeks ago talking about wills. It's not a pretty topic, but it's a topic that everyone kind of needs to have because
Exactly.
it's protecting yourself and your family. Most of all, when you're gone, you're leaving people with
Exactly.
you, right?
Yeah, everything you build up in your lifetime, in effect, you're leaving to your family. So it's the same with life insurance, right? It's just protecting your family from the inevitable and making sure that, you know, again, referring back to the case in my lifetime, making sure that everybody's protected and has a good life
Right.
onward if I'm not in it.
Okay, all right, good advice. So we've talked about universal life insurance, we've talked about mortgage life insurance. Now you've got your pick.
Yes, I got my pick.
Okay.
So I'll give you my pick, but what I like to do is my 20-pay insurance, which is a whole life permanent insurance product, it's expensive. So I'm not going to dissuade you and tell you that it's not. It's a pricey product, so you really have to make sure that it aligns with your budget. Because the worst thing you could do is get into something that you're going to cancel after 5 years. What I like to use is my pick along with a term insurance. So for example, a term 20 or a term 30 insurance, something that is going to stick with you for, you know, a 20 or 30-year period. That's going to, you know, you have a mortgage, you've got young kids on the way. You want to make sure that the most important time of your life, the most expensive time of your life, which is now, is you're suitably protected, and you can do that in a budget-friendly way using term insurance.
Okay.
So, but you still need permanent insurance because that's going to protect you and your wife or your spouse in the long run. So my pick is what's called a 20-pay insurance. It's a whole life insurance, and it's fantastic. Women love the product. Their eyes just get big when they see it, and they're always nudging their husbands that that's what they want. Because it's called 20-pay. The name pretty much gives it away. You pay for 20 years. And then at the end of the 20 years, you're paid up in full. You never, ever pay again. And you keep that coverage for the rest of your life. That doesn't mean you're not covered from day one. You're still covered, but you never make payments after the 20-year period.
Okay.
So what's nice about this product is that there's also what's called a guaranteed cash value within the product, which means that if you run into an emergency situation and you need cash, you can access this cash. Although I mean, I'm not condoning that.
Right. Because if you pull the cash out, what happens?
You lose the policy.
Right.
So, for example, if you had a $250,000 policy and you had $50,000 in cash sitting in there at year 20, that's guaranteed. So when they give you a guaranteed amount, it's not like the universal life. It doesn't fluctuate. It stays. It's a guaranteed amount. It states that in your contract. But it doesn't make much sense to take that money out and cancel the policy when you have a $250,000 death benefit. You've made the best investment probably in your life. It's just you're not going to, you know, you're not going to get it personally.
I'm going to take a step back. When you said it's expensive, how much are people usually contributing for the 20 years?
Well, for the 20-pay.
Okay.
So
yeah, for the 20 pay,
for the 20-pay for a $250,000 policy, I took mine out when I was 28 for $250,000. For my wife and I, it's about $200 a month. I mean, the prices are going up. The insurance industry, all the companies are raising their rates on permanent insurance because they're not making as much as they used to investing your money.
Okay.
So taking a step back, the cash value is very important because if you do run into a situation and you need that money, at least you know you have something there.
Right.
And even still, you got insurance basically free for 20 years and got your, you know, recouped the bulk of your money. What I kind of encourage is, what's nice about the product too is that the cash value, let's say at 20 years it's 50,000. Let's say when you're 75 or 85 years old, it's now half of the death benefit. Let's say you have $125,000 sitting in there when you're 75 or 85 and you need that for your retirement facility. Rather than cancel, what you can do is you can go to the bank and you can say, listen, I'd like to take out a collateral loan on that 125. I'll pay interest on it. But you know, at 85, it's likely that you're not going to live much longer than that. But you can use that for your retirement without lapsing the policy. And then what happens is when you die, the bank will get paid, and you'll have 125 left for your family. So it's a win-win.
Okay.
And I would honestly say that the reason why people love this product, just going back to it, young couples especially, is that by the time you're 50 or 45. It's paid up in full. You don't have to worry about it. Going back to the example that we spoke about with the universal life insurance, you know, the term 100, you'll pay it for life. This, you're only paying for 20 years.
Okay, I can see how that's desirable for some people. We've got a call. We've got Jason on the line from Thornhill. Hi, Jason.
Hi, how are you?
Good, thanks. How are you?
Good. I just want to say, Jack, you seem really knowledgeable, and I appreciate you taking the time to do this. I had a question about critical illness insurance. I'm wondering if you could tell us generally what types of illnesses are classified as critical illness insurances. For instance, cancer, or what type of illnesses would classify as a critical illness.
Sure. Yeah, I don't have the list in front of me, but the three primary ones would be life-threatening cancer, stroke, heart attack. It goes on to bypass surgery and Alzheimer's. I mean, there's about 24 different illnesses that are covered. We're actually going to be getting into that segment right after this one.
Yeah, we're going to be talking about critical illness after the break.
Yeah.
So stick around, Jason, because we'll be covering all those topics in greater detail.
Yeah, and if you want to call me, you can always call me personally, and I can give you all the information I have.
And we have Jack's website and his phone number available throughout the show on our screen. So stick around, and I'm sure you'll catch it.
Thanks very much.
Okay, so a little bit more as to why this is a great product for young couples, for maybe newlywed couples. There's an end in sight.
Yeah, there is an end in sight. I mean, 20 years paid in full. You never have to worry about paying it again, and you keep that coverage with you for life. It's like any investment, really. My insurance will be, I guess, it'll be paid up in the next about 15 years.
Okay.
14 years maybe. And you know what? I rarely see, once you make that commitment to the 20 pay, I rarely see people cancel it because you've invested all this money. It's a smart investment because you don't want to cancel it. Let's say you get to the 5 or the 10-year mark, you question yourself, why would I cancel this? I'm just going to keep on going, and no matter what, at least I'm going to have some cash value or a death benefit that's paid in full for my family.
Okay.
It's a great product, just a great product. I can't say enough about it.
Right. Okay. We've got another call. We've got Anthony on the line from Richmond Hill. Hi, Anthony.
Hi, how are you?
Good, thanks. How are you?
Good, good.
You have a question for Jack?
Yes, Jeff. I've heard of these 20-year policies. Is it true that usually the reason that you pay for 20 years and stop is that you're overpaying for the first 20 years into your policy, so that's why your premium is like really high?
Exactly. Yeah, that's very true. You're overfunding the policy. For example, if you look at the old example we saw with the Term 100, you can pay a permanent insurance policy traditionally till age 100. What this policy does is it condenses it into 20 years, so you're overpaying in the 20-year, within 20 years. Okay. So that's the notion of it.
Okay. Thanks so much, Anthony, for your call, and thanks to all of our other callers this segment. Don't go anywhere. We're going to take a short break. We're talking about critical illness insurance when we come back here on In the Know.